Welcome back, everyone. Today's video is something a little different. Something I've wrote about a few times, but I've never actually made a video on, and it is basically going to be the numbers that I use and the analysis that I would do when looking at banking stocks. Now, if this type of thing interests you and you want to see more data of the same in the future or similar videos on different things, please let me know. As always, this is not investment advice, and I should also say that, like many of you, I directly or indirectly own many of the stocks mentioned in this video. So in Canada, banks are either boring or millionaire makers, depending on who you ask. And many of us, particularly who know someone who's been in, perhaps a retail investor has been investing in Canada for a very long time, they probably have some banks in their portfolio, and they've probably been amongst the best performers, at least if they have one particular bank that's currently the largest in the country. And many people in Canada have basically invested in banks for a long time and had them reinvest their dividends and have become millionaires because of it. That said, they don't move very much. So how is this possible, one might ask? And what I'm going to be going into in this video is a look at the relevant metrics for banks. And those metrics are basically price to book and return on equity. And it's really kind of as simple as that. And then I'm going to be combining them to look at different ways that we could look at the banks and say, okay, this is what we might expect going forward. Now, before I get into the numbers, I just want to mention that this is a snapshot in time. All the data in this video is from late April 2025. And so as the share prices change, as the dividend yields change, as new results come in, this data will change slightly. Not much, but slightly. So just keep that in mind if you see, depending on when you see this video. And might do updates if people want to see more as more data comes in. So what things we'll look at today are which is the best bank, which has the highest return on equity, we'll rank them by things like payout ratio, which have the best expected returns, which has the most re-rate potential, and things like that. And I'll include some graphs. So with that, let's look at the first one. The first one being the best bank. The best bank is purely a function not of the best investment case, but of the bank that most consistently earns the highest return on equity. Now, I'm sure you have one in mind, but is it right? So what I've looked at here is the return on equity of each of the banks over the average return on equity over the last 5, 10, and 20 years. Now, one commonality, I used 8 banks. So I used the big 6 plus Laurentian and EQ. And while many of you were probably thinking that Royal would be the best bank over every period, I'll bet not many of you were thinking about how close it actually is. Because while Royal has been the best bank over the last 10 or 20 years, it actually hasn't been over the last 5, where National has actually put up some better results. Of the big 6, BMO has actually, Bank of Montreal has actually been the worst over every period, which also might be surprising given that its stock has done pretty decently. And I think that's a function of looking at expectations. It was never expected to be a fantastic bank, and so it had never priced that in. Whereas if you look at something like Scotiabank, which has been just fine over the last 20 years and not terrible over the last 10, it was at one point expected to be the best bank. Like if you look at the first decade of the data, it was one of the best banks. It might have been even better than Royal. And then it kind of trailed off. And that is kind of what was reflected in the stock price now. Not necessarily that it is necessarily the worst bank, because recently the results have kind of been similar to BMO, even when now everyone would say Scotia has been poor because the stock reflects that. Now, of course, outside of the big six, Laurentian has been far and away lower quality than the rest, but it's also been very similar. Like if you look between 16% return on equity and 15% return on equity, you get 5 different banks in that range. And I'll let you make your own judgments, but it's actually pretty close. Next, with far less commentary this time, we'll look at the payout ratio. Payout ratio based on if they were to earn the average return on equity of the last 5, 10, or 20 years, what would their normalized payout ratio be? And here you can see they're all pretty close. You can pause here and look at the data if I don't talk for long enough. That would be a miracle. But realistically, EQ is the only standout in terms of low payout ratio. The rest are all somewhat in the 40s, aside from Laurentian, which, due to the drop in return on equity, it matters which time frame you look at. Next, we're going to look at which bank has the highest IRR. We're going to use two ways of looking at this. I prefer the first, but you can prefer whichever you want. And this is based on either growth plus dividend, growth assuming they retain all the capital, or earnings yield. Basically, if they were to pay out their entire earnings yield and just leave it at that, what would your yield be? And this one has some interesting results, but they're all, again, kind of within a normal range of, on the short term, 10 to 12%, with the exception of perhaps EQ. Now, this one I find most interesting because you can look at the 20-year results and you can see that that is very much not priced in. And what is very priced in is the recent results. The last 5 years, the market's saying this is the type of return on equity that you're getting from a bank because that's what you've gotten recently. And this is what the bank is. And it may be accurate. And it may not, because again, for the first decade in the 20 years here, you had some very different things. Like you had National, that was not a very good bank, and you had Scotiabank, which was. And then in the last 5 years, you've had the complete opposite. So things will change over time, but or you could have things like Royal that have just been like excellent for 100 years, and you just never know. So I think that the reason why I've in other places mentioned that I like EQ is because it is a bit of a standout in terms of stealthily earns high return on equities and doesn't really get appreciated for it. But realistically, I think most of the banks could work as an investment. There's very few where I would straight up cross them off the list. And the other one is earnings yield. So this is earnings yield, which doesn't necessarily tell the story of what they get with their retained earnings. And this is why it makes Royal look like the worst, because, as I said before, they earn the highest return on equity, and that's kind of somewhat priced in. So lowest earnings yield, but still more of an average return. So it's up to everyone to think about which metric they like the most, what their style is, and if they think something's going to change, because it can at any given point. Next, I want to look a little bit at the re-rate potential. So this is basically looking at if the company were to improve the return on equity back to some average and they were to gain a multiple back to 10 times is what I'm going to look at. If they were to move to 10 times earnings based on their normal return on equity, how much upside or downside would they have? And again, this isn't necessarily fair, but a lot of people will say, or some people would say, banks, they normally trade at 8 to 12 times or 10 to 14 times or whatever multiple you want to slap on them. But this basically picks a number and says, okay, let's say that we're going to go to 10 times earnings because that's fair value, if it is. What would the change in the stock price be? And you can see most of them are, well, I mean, a lot of them are trading very close to what would be 10 times normal earnings. There are a few outliers. Again, Scotiabank, if you wanted to take the long run data, there's significant upside. EQ, there's some decent upside. Laurentian is all over the place. But if they can fix the bank, there might be some upside there too. Now, Royal, again, the premium, but you have to figure out how much of that might be offset by them doing better with what they retain. Next, I want to look briefly at earnings per share growth. So this is assuming no buybacks, how much will they grow their earnings? And again, on most time frames, it's pretty close, and it's what gives the banks a reputation for being boring, in that there's not much growth. There's 5 to 8% growth on most, maybe slightly more on national and EQ, but overall steady growth plus dividends, and it amounts to something, especially over long term, and especially if the banks continue to be high quality, goes up slowly type of stocks. Anyway, that is what I had for today. Please let me know if you like this type of video, you want more numerical analysis. I should leave you more time to look at the charts, less time. Well, you could also pause it if you want, but any comments are appreciated. Thank you for watching, and have a great day.